Anurag, good morning. Thanks for joining in. Anurag, 2 weeks to go until the presidential election outcome. Is this going to have a material impact on the direction of equity markets for Wall Street?
Samina, morning. Happy Friday. Yeah,
Also, Anurag, happy birthday to Neeraj.
yeah, that too. I would have waited if Neeraj asked a question, but yeah, so Neeraj, happy birthday.
Thank you so
By
much,
the way,
Anurag.
yeah, I heard of the 0-calorie cake. By the way, in my last visit to India, I saw so many of these sugar-free sweets. Like I refuse to believe there's anything called as sugar-free sweets. By the way, so I don't think there is any 0-calorie cake, but yeah, still do have something. Right,
Thank
by the
you.
way. So,
Thank you, Anurag. Much appreciated.
yeah, and so, Samina, elections will have an impact in the sense that, I mean, they will have or they will not have. Market is pricing in a Trump victory. But by the way, the key here is that the Republicans are likely to regain the control of Senate. And if Senate goes Republican, then it's a logjam either ways, even if Democrat win. And the president pretty much becomes a lame duck president. They can't decide anything. Even the cabinet has to be approved by the Senate. So that kind of brings a checks and balances kind of for the government. So that's a view on the elections, right? But at the same time, I think there were quick data points. I heard you talk about the unemployment number at 1.9 million. That's exactly the kind of number we had before 2020. So it's not it is all coming back to normal. It's nothing, there's nothing abnormal about it. It's not a panic. The recession numbers are like 3 million, 3.5 million or 4 million, right? 2 million unemployment claims continuing basis. It's pretty much exactly back to where it should be. So I think all otherwise looks very good, in US, except that the broadening of the rally has to happen outside of these seven stocks. So 7 versus 493, the typical battle that we always talk about, that's underway. And that's why you find that the last couple of months, the equal weighted index is rising more than the overall S&P index because the big seven are kind of taking a big break. Samina.
Right. Anurag, what are you making about all this talk about more money moving away from India into China? We did get some data on fund flows a few weeks ago, and it seemed like Chinese inflow is actually not coming in at the cost of India. What China is getting is incremental flows that would go into Europe that are actually finding their way to China. Do you think the debate holds and not strategic? Because I'd like to believe that India still is a strategic long-term preferred bet to China. But tactically, over the course of the next 3 to 6 months, do you feel like incremental flows, or we may potentially see outflows that may make their way either into Wall Street or China, largely on back of valuations?
So, Samina, big picture first. Here is the big picture on emerging market flows. 10% of the ETF allocations goes to emerging markets. Of this 10%, about 20% is India weightage. So which is where, if the $100 is invested, in the US markets, about $2 of that finds a way to, Indian markets. Indian GDP is about 3.5 trillion. So it's a shade below the normal weightage. But look at in the last few months, China had dropped down to almost like 25%. For the size of Chinese economy, I think that number was too low. So it is good that the Chinese government has kind of woken up to this reality and taken a notice. Now, to your point, look, there are three challenges. There is a monetary problem, monetary stimulus, there is a fiscal stimulus, and there are structural demand creation problem, right? China is facing a demand scarcity. Now, they can solve for the monetary problem, they can solve for the fiscal problem. And I think in the short term, that's all investors needed to know, that they're not there to kill capitalism and it will thrive. So I think a re-rating was waiting to happen from a 9 PE to a 15, 16, 17 PE. So I think that will happen. I don't think India will lose too much in the sense that, maybe a 20% weightage in MSCI can go down to 18. I think that's marginal. But beyond that, it's not that, the money is totally going to change places because world is a little more cautious on China as well. But that said, it's not that there's nothing to jump into the Indian markets as well. The The markets have really taken a big leap in the last 3 years when the world was under pause. So I think it is India's time to take a bit of a pause now, I think, which will be very healthy.
Just wondering, Anurag, is this at worst a pause, or the worst could be a substantial decline because the street is divided there when it comes to India?
So Neeraj, I think you've been a veteran in the market for so long, and I think my sense is we've all seen 2008, and we've seen the great stagnation between 2008 and 2018 and 19, right? Where every time the earnings kind of almost grew by what, like 3, 4, 5%. That's about it between those 10 years. So I think I have more reasons to believe that the earnings, nifty earnings, let's say, that rose from something like a 430 rupees to something like a 950 or 1000 from 2020 to 2024. That's a CAGR of 22%. Now, that's not something which is sustainable. It all happened because the bank earnings peaked, technology got a big push, government spending came in, and I think even the consumers fired because of this stimulus pre-COVID, post-COVID, the revenge buying by the consumers post-COVID. So I think all of these industries kind of peaked at the same time. But I don't think, and I think it's pretty evident if you just see numbers from Bajaj Auto, Unilever, and Ultratech. I think the economy also needs to slow down. I think if I were to just leave you with a big picture thought, look at the nominal GDP growth of India. It is just about 10% for the last 10 years. So since 2014, the nominal GDP is growing at give or take 10% average. If that is the case, how can earnings be growing at 22% beyond a temporary blip, right? So that's my broad thesis, Neeraj. And I think to the investors, message is, if you buy anything now, next 5 years going to be very, very muted. It has happened in the past. It will happen right again. I have no reason to believe the earnings structurally have gone to a 15 or 20% CAGR rate, especially in a low inflation environment. Neeraj.
Noted.